And we now return to our top story today on a review by the central bank that shows Singapore firms and households remaining resilient despite rising interest rates. And for more on that, we speak with Professor Sumit Agarwal. He is Professor of Finance, Economics and Real Estate from NUS Business School. Professor Agarwal, thank you for joining us this evening. So first off, the report points to increased risks in the global financial system from these potentially higher for longer interest rates. Can we assume that this could also mean higher for longer inflation? And when will all this end?
I'm not sure I can answer when will this end, but clearly I think the report is on the mark by saying this could mean higher interest rate, but a higher inflation as well. And the reasons have shifted. Earlier, the reasons were because of supply shortages that was causing higher inflation and interest rates. But now we see global risks, which are political economic risks, like what we are seeing in the Middle East, obviously the ongoing war in Russia, and so on and so forth, and the unknown other risks that we can foresee.
Professor Agarwal, I suppose I should pick you up on that point. The report saying Singapore looks to be resilient, stable, both in corporates as well as households, but also citing, as you just mentioned, these various risks that can upend that could upend anything. So the unknown unknowns. Is there a combination of unknown unknowns that we really need to be looking out for?
Clearly, there are many. I mean, they could be from the long term. That could be think about climate change and sustainability issues. Sea level rise, obviously, that is a big threat to Singapore. And obviously, more immediate ones that could be related to shocks, that we are seeing, geopolitical shocks. We could see others erupt within Asia itself, you can imagine. And obviously, there could be some medium-term issues, that kind of things that we have seen in the US, the banking crisis that happened earlier this year. And any of these kind of things can happen around the corner in this neighborhood itself.
You mentioned the banking crisis, Professor Agarwal. I mean, we did see major banks collapse earlier this year. MAS says that Singapore banks do have buffers for risks, but when it comes to our deposits, if there were to be a large global financial crisis of some dimensions, would our deposits be safe?
I think Singapore has done very well because of the initiatives from MAS in terms of macroprudential risk that it can foresee. That's how it buffered the consumers against the higher inflation, higher interest rates. For example, debt to income, loan to value ratios are very low in Singapore relative to the rest of the world. Even deposit insurance and lots of other mechanisms the MAS has instated over the last 10 years or so. I think Singapore is relatively safe relative to the rest of the world.
Professor Agarwal, MAS confident households can cope with higher mortgage rates. Earlier, we ran a report saying perhaps households might draw on accumulated savings or use their CPF to offset these larger monthly mortgage payments. But this would affect how households would then see their financial security now and in the future when they think of buying things. So it's not just, I'll take my savings and I feel okay about this. What will be affected should consumers have to draw on their savings, their reserves in order to meet their current mortgage rates?
Yes, so I think you're asking two questions. One is existing homeowners, one is new homeowners. Clearly, the existing homeowners are going to feel the pinch of higher interest rates, and the macroprudential policies are actually working in that sense right now. For the new homeowners, I think there is an issue. They need to think and time when to get into the housing markets because higher interest rates mean higher debt service burdens. So I think if I would caution them to say, okay, maybe we can wait a little. Let's see how the interest rates move in the near future. If they can come down a little bit, and maybe that's the right time so that they have less debt service burden.
Professor Agarwal, even resilient companies are being asked to be financially prudent, to basically have enough buffer to weather potential risks. Is there a balance that needs to be struck between asking companies to continue to grow, to continue to go overseas, as an example, attract more business, and on the opposite side, to exploit economic opportunities, to basically say, look, take that into account, but also stay prudent at the same time? Is it a zero-sum game?
That's a good question. I mean, I think it is a dilemma a lot of companies are facing. Should they be more aggressive at this point? And because they have good balance sheets, should they go out and look for opportunities versus the risk of higher interest rates and actually being more prudent? I mean, I think the major headwinds are behind us. There is still some lingering higher interest rates, which should be coming down in the short run in the next 3 to 6 months itself. And so I would be more optimistic in terms of, if I was a corporate leader, to where I want to take my company and my efforts to actually grow and actually acquire things.
Thanks so much, Professor Sumit Agarwal from the NUS Business School.